Yo, what's going on, guys? In today's video, we're gonna be going over what to expect when you guys start live trading. Now, live trading doesn't mean fucking using like an actual funded account or an actual live account. Live trading means just trading live, trading with the live current data that's coming into the market. So, what you guys can do is you can click on the bottom right corner here of your guys' charts right here. You can click on paper trading. Okay. No, and then after you click that, you press connect. Okay. Now, after you connect your paper trading account, you usually have an account balance of about $100,000. Okay, with that $100,000, you're going to be trying to mimic that of what your goal would be on a funded account, as that is going to be your practice experience of gaining equity. Okay, so if you got $100,000 account, right? Usually for most prop firms, you're depending on what kind of account you get. If you have a two-step, which is probably the most common, um, your target is usually going to be about 10% of the account. So if you have $100,000 account, your target goal would be about $10,000. So with that $100,000 account, your goal should be to get $110,000 in equity, which would mean $10,000 profit target. So with that $100,000, you want to get $10,000 without getting into drawdown of 10% drawdown. Okay? So you don't want to go below, you don't want to get to $90,000 equity. What you want to do is get to $110,000 in equity, okay? So when you get to there, that usually will indicate to you that you have, you practiced with fake money, because this is a paper trading account. This is fake money, all right? So with that, you're usually going to have that indication to you that maybe I'm gonna want to start risking actual money with this. After you've had some practices with this fake account, with fake money, okay, using real live data, you can do this by um, practicing with fake money before you actually jump into the market with real money. So in doing this, this is actually gaining you practice for the actual live charts with actual live money that you spend on either that funded account or that live account. Whether you go the live account route, which is a bigger step than going the funded account route, but nonetheless, it is a good way to start with trading without actually risking your own hard-earned money. Okay, so um, but in today's video, we're gonna be going over how to basically just what to expect when you jump into the charts on you know just start live trading in general. So I'm gonna give you guys a little walkthrough, a basic walkthrough of what you should be expecting, what you guys should be looking for. Okay, so when you hop into the charts, you open up TradingView. Boom, TradingView is open. What's the first thing that you want to do? You want to find your daily bias. Okay, now remember, daily bias is whatever direction you perceive the market in going for that day. Okay, so with that daily bias, you believe that the market is going to go bearish, or you believe the market is going to go bullish, depending on what you perceive the market on doing. All right, so with that, we want to find daily bias. Yeah, so find daily bias. That's our number one priority at the moment. So that's the first number one priority you want to do when you log in to TradingView. Okay, when you put your charts on, first thing you want to find is your daily bias. Now, why do we want to find our daily bias and not just go straight up to our setup? Reason for our daily bias is if we have no bias, right, and we're starting to form a setup on the lower time frames, but the market fucks us over and goes in the opposite direction, we're gonna be like, why did it do that? We do the same thing tomorrow? It fucks us over again in the opposite direction. Why did it do that? Reason for that is because we didn't have a bias. We didn't have a higher time frame bias based off of what was happening on the monthly, the weekly, the daily, the 4 hour, the 1 hour time frame. All of those higher time frames, they carry more bulk and volume in the candles. So the more bulk and volume in the candles matters more than the lower time frames. Lower time frames don't mean shit. You think these institutions are trading on fucking lower time frames? You think you think Chase Bank is going onto the 1 minute time frame and being like, oh, I'm gonna put fucking 20 billion trillion dollars into the market right now on this 1 minute fair value? No, they're not. We use these lower time frames to find us our setups because we don't have enough capital to go with how they're doing. They have enough capital, we don't. So what we use is the high frequency algorithms on the lower time frames to line up with what they do on the higher time frames, which is why we need to find out what the daily bias is on the higher time frames, on the monthly, the weekly, the daily, the 4 hour, the 1 hour, so that we can use that bias to trade in the intended direction of the market on the lower time frames. So like the 15-minute, the 5-minute, the 3-minute, the 1 minute. And then if you have, if you have the other TradingView memberships, you can go on the 30-second, the 15-second, even the fucking 5 and 1 second, which I recommend not doing the 5 and the 1 second, at most 15-second chart. But yeah, so first priority, find daily bias. That's the first thing. Now, what market are we finding our daily bias on? So remember, risk on and risk off scenarios. That means dollar, if it's rising, we want to see indices and foreign exchange markets and equity markets dropping. So if dollar is going up, okay, imagine this is dollar. We want to see indices heading down. That's what we want to see. We want to see the two total opposites of each other. We want to see it going up on dollar. We want to see it going down on indices. Same thing. If dollar is trending downwards, what do we want to see on indices? We want to see it heading bullish. So this is a risk on versus risk off scenario. Risk on, risk off. Okay, remember that. Risk on and risk off scenarios is DXY dropping, indices rising. Dollar rising, indices dropping. Same thing if you're trading foreign exchange markets. Dollar rising, Forex dropping. Dollar dropping, Forex rising. And same thing with equity markets, okay? It goes hand in hand. So whatever the dollar is doing, DXY, whatever the DXY pair is doing, we usually want to be trading in the opposite direction of that. If they're both trading in the same direction, however, that means there is a miscorrelation between the two, because they should be going in the opposite direction of each other. Okay? So remember that. So first thing we want to do is figure out our daily bias. Now how are we going to do that? We want to be marking out our external range highs and lows. So our buy side and sell side liquidity on either starting off with the weekly, okay? We want to start off with the weekly and then drop down in lower time frames over time, okay? So buy side here, sell side here. That's our externals, for example, right? You want to start off with that. After you start off with that, remember the daily bias video that I put out into the mentorship course. Remember, watch that back. Watch it, and then watch it again, and then try it out right here on the DXY chart. So what I want you to do is I want you to mark out your externals, so your buy side and sell side, then do the 5 steps to find your daily bias that I've taught you guys in that video. With that video, with that daily bias, now you're going to use that and then hold that idea all the way down to the 4 hour and the 1 hour time frame, right? On DXY. You're going to hold that idea. While you're holding that idea, now what you're going to want to do is you're going to come back to the weekly. And guess what market you're going to come to? You're going to go to NASDAQ or ES, whichever one you're going to trade. Whether you're trading S&P, NASDAQ, US 30. You're going to do the same thing, whatever, fucking Forex. Do the same thing with all of those markets. Do the weekly, daily, 4 hour, 1 hour with the 5 steps that I've taught you guys in the previous video. Okay? And no, I'm not going to go over the steps again. Why? Because I already made a designated video for that. I walked you guys through it, and I also gave you guys an example for it. So if you guys need a little refresher of it, you guys can rewatch the video. And it is good that you rewatch videos. Why? Because it gets you like familiar with what I taught you guys, alright? I'm giving you guys sauce here. Now, I'm not the person who created it. I'm just the messenger, alright? Fuck. Alright? So, on NASDAQ, you're going to do the same thing with the daily bias, alright? Once you get your daily bias on NASDAQ, if you see it going bullish and DXY is going bearish, that's a good sign. But if you see it going bearish and DXY is going bearish, you need to see which one is going to be incorrect, whether it's going to be you or whether it's going to be your DXY analysis. All right? But you're usually going to want to have your analyses be in the opposite direction of each other. Usually, you're going to want it to be in the opposite direction of each other, all right? So, whatever your DXY is, say it's going bearish, right? You're going to have a little insight of that NASDAQ is most likely going to be coming bullish, but you're going to want to find a bullish daily bias analysis with NASDAQ, right? So, on DXY, you're going to do the 5 steps, find your daily bias on that, or on DXY, you're going to do your 5 steps, and then you're going to figure out your daily bias on DXY. NASDAQ, ES, YM, whatever. Fucking GU, EU, fucking, whatever. GJ, whatever pair that you're going to be trading, alright? You're going to find your daily bias on that designated pair. For me, it's going to be NQ, NASDAQ, alright? So, after you find your daily bias on this one, you're going to be wanting to bias yourself in the opposite direction of DXY. And if you're going to have them both being in the same direction, you're going to see which one lines up with the actual draw on liquidity. Now, after you find your daily bias, say we're bullish on NQ, right? What we're going to be doing is we're going to drop down to the 4-hour and the 1-hour time frame. Okay? So the 4-hour and the 1-hour time frame, alright? So say we're on the 4-hour time frame here. Mark made our daily bias saying we're bullish, right? Whatever. You're going to be marking out your external highs and your external lows. Okay? After you marked out your external highs and external lows, you're going to drop down to the 1-hour. Now, when we drop it down to this 1-hour time frame, what you're going to be looking to do is shrink down the range even more based off of what? Retracements to liquidity points. So that's sell side or buy side or inefficiencies, okay? Every time we have taken out a major level of liquidity or every time we have filled a major inefficiency, that's when the range changes, okay? So when we come up here, we fill this inefficiency. Now the range is from this low to this high, okay? That's our range. Market came down, tapped this order block. This is our range now. Created equal lows. Still in the range. Still in the range. Came all the way back up now. Breaking through this buy side here. This is our range from this low all the way to that high. Now that we have this high dropping all the way back down to this low, what do? We took out relative equal lows here. So relative equal lows, they got taken out here. So what is our buy? What is our sell side here? This is our sell side liquidity now. Okay? And then the market came up, retracing into this fair value gap here. So what is our buy side now? This is our buy side here. Okay? So now this is our trading range. From this low to this high. That is our trading range. And this trading range is where we want to find our setup here on the lower time frame. So the 15, the 5 minute, and the 1 minute. Okay? So, for example, you're going to be wanting to find your higher time frame bias lining up with your lower time frame bias, okay? So you always want to have your lower time frame bias be in the same direction as your higher time frame bias, in that you can find a setup on the lower time frames that lines up with the higher time frames. So on the lower time frames, or on the higher time frames, say if we're bullish, right? Market came up and now it's coming back down. Remember, premium and discount. Where do we buy in? We buy in discount, right? Premium, discount. Where are we in right now? Discount. Now, what PD raise can we use to enter off of? We have a 1-hour BISI right here. Okay, so we got a 1 minute BISI right here. And also if we use OTE, boom, it's an OTE as well. So, using that, that's already a solid indication to us where the market could possibly be going. Why? Because we have 3 confluences already. We are in discount, unmitigated fair value gap that we can retrace into, and it's an OTE, right? and it's an OTE. So because of that, we have an idea of what the possible draw on liquidity is. Remember, what is draw on liquidity? Draw on liquidity is where the market wants to go to. So we have an idea that the market could possibly come down into this and retrace higher. Now, are we going to enter on this fair value gap? No. Why? We're on the 1 hour time frame. We are on the 1 hour time frame. How big would our stops have to be if we entered on this gap? 500 ticks. We're not risking 500 fucking ticks for a fucking stop loss. That's bullshit. Nobody's gonna be doing that. Not even me. I would never do that. I would never risk 500 tick stop loss. I wouldn't even risk 100 tick stop loss. That's fucking stupid. Only time I'm risking 100 tick stop loss is if I'm using literally super small size. Super small. Literally super small. I am not doing that. I'm not risking 100 tick stop loss. I'm not risking 500 tick stop loss. So that's stupid. So what's the purpose of finding this fucking draw on liquidity? Why? Because if we tap into this on the 1 hour time frame, on the 5-minute time frame, we're going to have a whole trading model set up. So on the 1 hour time frame, once we tap into this, what could we possibly see? Okay, what could we see? We could see us take out a level of liquidity. What liquidity? Boom, right here. Boom, right here. We could have took out these levels of liquidity. So here. And here. We have 2 levels of liquidity that we would be taking out. Possibly taking out. So while on the 1 hour time frame, we're rejecting this, right? On the 5-minute time frame, we're actually taking out liquidity. And that is called a turtle soup, okay? Where you tap into a higher time frame PDR, you're actually sweeping liquidity on the lower time frames, okay? And that is known as a turtle soup, alright? This is when you sweep liquidity on the lower time frames, tap into a higher time frame PDR. Our 1 hour fair value gap is our higher time frame PDR. 5-minute time frame, that is going to be our lower time frame liquidity points. So our sell sides, our 2 sell sides right here. Okay? After we do that, after we sweep these 2, we're tapping into this at the same time. What's another thing we can look for? We can look for an SMT. Okay? So we look for an SMT. What do we want to see? We want to see both markets having a miscorrelation with each other. Now, what's an example of an SMT? Let's find one here. Wait, you guys are probably like, you're so fucking unprepared. Fuck yeah, I am. The fuck? Doing it on the fly. Why wouldn't I do it on the fly? Let's see. Let's go on yes. Alright, here we go. Okay. So we got a bearish SMT here. Okay. Bearish SMT here. Right here. Now, this is a linear SMT, okay? Linear SMT. Now, what's a fucking linear SMT, if you may ask? A linear SMT is correlated markets that should be moving in the same direction, okay? The same direction. Now, what makes it an SMT? That's when we have a crack in correlation between the 2 markets, right? One creates a lower low or a lower high. One creates a higher high. Now, why is that even important? Why is that important, Pono? Well, because on the market that we created that lower high, and we'll even move this to over here, and we'll even move this to over here, make it even better. The market that we created that lower high on, we didn't take liquidity. market will be that we took liquidity on, that higher high. We swept liquidity on S&P. We didn't sweep on NASDAQ. So what does that mean? That means we already swept liquidity on ES. There's no reason for ES to come up a second time to sweep liquidity again. It already swept liquidity. So on NASDAQ, it doesn't need to take liquidity. Seeing this SMT, this is spotting a reversal about to come. So because we spotted this SMT here, we can anticipate that the market's going to head bearish right here. Okay? So because we spotted that SMT, we can anticipate the market's going to be bearish. What we want to see though, you want to see a bullish SMT, a bullish one. So we don't have it yet because this is current market time. What we would want to see is one market creating a lower low, right? So for example, if YN creates a lower low, we want to see one market create a higher low. Okay? That's what we want to see, a bullish SMT. That's something else we can look out for. And then the final thing that I would want you guys to set up your model is that 2022 model that I made a video for you guys about. Just remember, what's the first step? Liquidity sweep. We swept 2 levels of liquidity. That's the first step done. What's the next step? A market structure shift. A bullish market structure shift in this scenario. What does that look like? Low, high, lower low, higher high. This is our bullish market structure shift. And just for insights, what a bullish market structure shift will look like, it will look like this. Okay? And I'll go on I'll stay on this time frame. Okay? So if we're gonna use an intermediate term high, right? We'll use an intermediate term high, which would be this high. This designated intermediate term high. We are changing. Remember, a market structure shift is a change in state of delivery. What is that? A change in market sentiment. So what does that mean? We're going from bearish to bullish, or bullish to bearish. That's very simple. We're going from bearish to bullish. This is our intermediate term high. How do we know it's an intermediate term high? Short term high here, short term high here. That's our intermediate term high. So when we sweep or displace over an intermediate term high, that's a major change for us, all right? So this intermediate term high, we want to see displacement through it. Why? Because that's going to be our shift in market structure, our definite shift in market structure. Okay? Now, we can displace over a short-term high. Now, we can use that as a market structure shift as well. But displacing over an intermediate term high is just way more confluential for us to use as a definite shift in market structure. So, creating our low, high, lower low, and you see how we bounce back and forth here, creating a short-term high here. Why is this a short-term high? There's no short-term highs to the left or right of it, okay? This is our short-term high. This is our intermediate term high. This is our short-term, intermediate term, short-term, okay? Higher high, creating our higher high. Remember, displacement. Displacement, what is displacement? Having that body close over that high, boom, displacement. Having big movement to the upside, displacement, big displacement. That's what we want to see. All right, so that will be our shift in market structure. So remember, what we want to see is a shift in market structure. We want to have our change in state of delivery. We want to have our market structure shift. That's the second step. Third and final step is a fair value gap. Now, those of you who don't remember what a fair value gap is, that's a fair value gap. That's a fair value gap. One that gets filled, right here. That's a fair value gap. These are all fair value gaps, all 3 of these. These are SIBIs. This is a BISI. And that's going to be your entry point. Alright, so the 3 things that you're going to be looking for your model is going to be a liquidity sweep, which we get here. Market structure shift, a bullish one in this scenario, and a fair value gap. That's going to be the point of where you enter your trade at, okay? And that's going to be what it's going to be looking like. And that's what you can be expecting when you come into the trading day, all right? Now, when you're done trading, You're going to journal everything that you did. And look at the video before this so that you can figure out how to journal. Okay? And it's important that you journal. If you don't journal, it's like doing a science experiment without writing anything that you experimented down. Okay? You need to write shit down. You need to write down whatever happened. Why? So that you can improve the next time. Okay? That's the purpose of journaling. Other than that, use this video, come back to it if you need to, so that when you come into your trading day, keep it simple and you build on it slowly. You don't want to come into the trading day, mark out a few things. Oh, there's a fair value gap here. There's an inverse here. There's a BPR here. Took out liquidity, whatever, right? You don't want to do that. Why? Because you're clueless. You're fucking clueless. You don't want to be clueless. You want to be sure of what you're looking for. You want to know what you're looking for. When you come into the trading day, you don't want to be like, well, I think it's going to do this. I mean, it could possibly do this. No. You want to say, I want price to do this, this, and that. I want price to come down into this fair value gap. I want price to sweep these levels of sell side. I want price to have a shift in market structure on the 5 minute. I want price to have a fair value gap that I can enter on. And that's what I'm looking for. I'm looking for that shit to happen. You want to manifest that shit into coming into existence. Say it out loud. Say it with your fucking chest. Don't be fucking scared about it. Have confidence when you're looking at it. Don't be like, I think it could possibly do that. I think it could possibly come into this gap. I'm really hoping it has a shift in market structure. No. Look at it like this. I want price to come down into this fair value gap, and I'm looking for it to make a market structure shift. Why? So that I can enter on a fair value gap when it displaces. That's why. Okay? That is going to be what you're going to be talking about to yourself. Saying to yourself, anticipating for yourself, having the confidence for yourself, doing that. Not just second guessing yourself. Don't do that. Alright? So, when you come into the day, have confidence. Also, don't be impulsive. Don't take fucking stupid ass trades. Alright? What do I mean, don't take stupid ass trades? If you see a fucking fair value gap, don't enter on it unless you have a setup with it. If you have your daily bias and you're bearish and you're entering on a bullish gap, what the fuck are you doing? You just made your whole daily bias just for you to fucking trade in the opposite direction. Don't do that. Trade in the direction you had your bias for the day. Okay? You need to fix that. You need to fix that. Why? Because it's a perception thing. You need to trust yourself. You can't just fucking, doubt yourself the moment you see an available opportunity in the opposite direction. No, you need to trust your analysis. And if you were wrong, then you were wrong. Fucking accept it. It's not a big deal. It's literally not a big deal. It's literally the smallest fucking minute detail of, focus on the Homelander, but the smallest fucking detail of, not fucking mattering if you're fucking wrong. Okay? When you come into the day, expect to be fucking incorrect. It's not about being right all the fucking time. Or, fuck, I can't even talk. It's not about being right, okay? It's not about being right. It's literally not. It's literally not about being right at fucking all. Like, being right is just an addition to you trading. What will make you profitable and what will help you survive this fucking game of trading for a long time is having good risk management. When you ask someone who has poor risk management, if they took 4 trades and 1 win and the rest were 3 losses. So 4 trades, 1 win, 3 losses. If you ask them how they dealt with that and how they traded that, they're going to say they're in drawdown. Most definitely they're going to say in drawdown. You ask somebody who has good risk management, if they had 3 losses and 1 win, I can guarantee you 90 to 95% of the people that have really good risk management, they're either break even on the day or they're a little bit in profit. I can fucking promise you that. I can promise you that. That they're break even on the day or they're in profit for the day. And they lost more than they won. Why? Because they had good risk management. Pono, where can I learn that? Where can I learn how to have good risk management? You wanna know where? In the second damn video of this fucking mentorship. Why? I put it at the beginning for a reason. Why? Because it's the most crucial element of surviving this. If you don't have money, how the fuck are you gonna trade? You need money. You need to have a fundamental aspect of money. You need to survive the money part. You need to keep your capital. If you can't preserve your capital, then what's the point of trading if you can't even keep it? You need to keep your capital, alright? So remember that. Now, with the risk management, you need to add on top of that your strategy. And what strategy will that be? The most basic strategy in the world. What is that? The 2022 model. Pono, where can I learn to trade the 2022 model? Simple. I made a video for you guys. But I don't want to watch that video. So fucking what? I gave you guys the steps. I gave you the time frames for each steps. I also gave you guys not only an example, I gave you 2 examples, a bullish and a bearish example. What else did I give you? I gave you guys a walkthrough of how to find it. I gave you everything in that video. Alright? I gave you all of that shit. All of that shit in that video. I gave you all of it. Alright? In that video, I gave you all of that shit. And if you're expecting me to show you it step by step again, after I made a clear video for you guys, I'm not gonna do that for you guys. Why? Because I gave you guys everything for, like, in that video. It's literally all there. All of that shit is there. So if you need help, you guys can ask me. But don't expect me to fucking show you guys the fucking left and right, where the fuck to put your hands on the fucking steering wheel. Everything is there. I gave you guys all of that shit. All of that fucking shit. And if you don't understand, and you want to see it playing out in real time, join the live trades. Live trade with me. I'm going to be there, putting setups on. Alright? Join the live trading. Super simple. Join the live trading. Now, coming to the day, DXY daily bias, NQ daily bias, lower time frames, external range highs and lows. Find your premium and discount. Find your higher time frame PD rays that are unmitigated. Line that up with your bias. Find your models on the lower time frames, the 1 minute, the 5 minute, 15 minute. Look for that super liquidity. Look for that market structure shift. Look for that fair value gap. And line that up with your higher time frame bias. You do all of that, I can guarantee you'll have some pretty good days. Alright? Now don't fucking doubt your guys' selves. Alright? This trading shit is hard. But it's about being disciplined and sticking with it, because this is a hard game, but there's no other job in the world you can do this type shit. Alright? But I hope you guys have a good rest of your guys' day, and I'll see you guys in the next video. Peace.